This is Real Estate Rookie episode 170. My name is Ashley Kerr, and I'm here with my co-host, Tony Robinson.
And welcome to the Real Estate Rookie Podcast, where what we do is we focus on those real estate investors who are at the beginning of their journey. So maybe you've got no deals, maybe you've got one or two and you're looking to scale up. If so, this is the podcast for you, because every week, twice a week, we bring you the inspiration, information you need to get started. Ashley Kerr, what's going on? How are things in your neck of the woods?
Good. So today we actually have a question from my DM. So if you want to just jump into it today, we'll get started. I'm actually excited about this one because this one we got to get a little freaky in the spreadsheets as to analyzing numbers and figure it out. So let me pull up the question here. Okay, so this is from Chana Chin. And this is from my DMs on Instagram at Wealth from Rentals, or you can send a DM to Tony at Tony J. Robinson if you guys want have a question that you want us to play on the podcast. She said, "Good evening, Ashley. My name is Chana Chin. I am a new real estate investor. About 6 months ago, I read Rich Dad, Poor Dad, and I listened to your podcast and Bigger Pockets Money podcast. Now I have bought 3 rental houses, 4 units total. And the last 2 houses I bought with cash and now looking for refinance and take my money back. I've been talking to the bank around my area. They said they can do 2 different options. So option 1, they can loan me on all 3 houses in one loan, but it would have to be a 3.5% interest rate, a 5-year ARM with small closing costs. So the 5-year ARM means that you will have a fixed rate for 5 years, and that is that 3.5%. And then after 5 years, you will have to, you'll go to a variable rate, or you can refinance to get another fixed rate. The second option is to have 3 separate fixed rate loans. So each property will have their own mortgage. It would be at a 3.875% and a 30-year fixed instead of just a 5-year fixed. So some of the differences here are the interest rate. The first one is a 3.5% if you do one loan. If you do the 3 separate ones, it's a 3.875%, which, Tony, in my opinion, I think both of these are still pretty low.
Yeah, those are still pretty solid rates.
Yeah. So then the second difference is that the first one is only fixed for 5 years, and the second one is fixed for 30 years. Tony, you want to kind of explain what your thoughts on the difference in having those 2 fixed rates?
Let's if we can, let's just kind of break down the pros and cons of each option, right? Because each option has its strengths. Option 1, there's only one loan that you have to deal with, which is nice, right? Anyone who has multiple properties and multiple loans knows that can be a bit of a headache. So only having one loan to deal with is a good thing. The interest rate is, a few basis points lower, right? 3.5 versus 3.875. So you'll save a little bit of money on interest with the lower interest rate. The cons of the ARM are that it's not fixed, right? After 5 years, who knows where your interest rate could be? So you'll get a really nice interest rate of 3.5 for the first 5 years, and then who knows? Maybe it's 4.5, maybe it's 5. Who knows what it'll be 5 years from now? So there's some uncertainty around what the long-term cost of that loan will be. Now, for the fixed rates, the pros are that it's a fixed rate, right? For the life of that loan, as long as you don't refinance, you're going to be paying 3.875% for 30 years, which is good to know. The cons are that you're paying a little bit more in interest, right? At least for those first 5 years. And the other con is that you have the additional closing costs, right? There's closing costs per loan. So you're going to spend a little bit more money out of pocket to get those properties or to get those loans set up. So those, at a high level, I think those are kind of the pros and cons of each. Did I miss anything, Ash?
No, I don't think so. You hit basically the big ones here is to what to consider when you are looking at mortgage options. So what Tony and I did was we actually ran the numbers on these mortgage payments to kind of look at what they would be. And we don't have all the option or all of the information. We don't know exactly what the closing costs were on each of these. We do know that the closing costs were less on the first option of only one and more for the second option of if you're separating all three out, which is, that's right. That's justifiable because you're doing three different loans. You're going to have three different mortgages filed. There's three sets of paperwork for an attorney to do. So having the three separate loans definitely will increase your closing costs. So that's not something that's uncommon. So we ran an amortization calculator. So that is where you plug in how much your loan amount is for, what is the interest rate, and then also how many years is this amortized over for. So once you run the amortization period, we did it for both of these. And so we took the first 5 years for the first option, and the loan payment for the month was $1,347. Then we took option 2 and ran it for 3 separate loans. And we didn't know the values, but we used $300,000 so that each house was $100,000 each. And then, so if we did the 3 separate loans at 30 years at the 3.875%, that mortgage payment came to $1,410. So monthly cash flow, that is a difference of $63. We're doing the 3 separate loans would be $63 higher every month. So then we looked at the interest rate and how much interest you'd be paying over the years. So if you did the first option over a 5-year period, you'd be paying $50,704 in interest over those 5 years. In 5 years for the 3 separate loans, you'd be paying $56,307. So about a $5,500 difference over that time frame. So those are the things we looked at. And then obviously we don't know the closing costs. So me personally, I would go with the second option of doing the 3 individual loans. So that your loan payment is not going to, affect your cash flow that much. And if that $63 is really going to hurt your cash flow, having 3 properties, that's probably not a good deal. Anyways, if you're going to be hurting off of a $63 difference. The second thing is the interest isn't a huge amount over 5 years that you're paying extra on the loan. The thing I like is that you have that security of knowing what your interest rate is going to be for 30 years. And then having it change in 5 years. I also like having the 3 different mortgage payments. So if I decided, you know what, I don't want a $1,400 mortgage payment anymore. I want to pay off a property. I want to own a property free and clear. You can do that without really affecting your mortgage. You can also go and, pay down a big lump sum on your mortgage and get a property taken off. But that's a lot more of a process than just paying off one property and getting that mortgage taken away.
Yeah, lots of good points there, Ashley. I mean, I agree with you totally. If I were in her position, knowing what I know, I would probably go with that second option, having the 3 separate mortgages as well. And to me, it's everything you mentioned, but the interest rates I think are what stand out to me the most. Like I actually looked it up right now while you were going through your points here, and I just want to break out kind of what interest rates look like decade by decade, so we all can kind of have a better historical context of where rates are today. Because I think a lot of people are freaking out that rates have gone up, in the last 12 months or since the beginning of the year. But historically, we still have really, really low interest rates. So in the 70s, interest rates on average were about the mid 7s, right? In the early 70s. They ended the 70s. So by 79, 11.2 was the average interest rate for a mortgage. In the 80s, and this is almost unbelievable, right? In the 80s, it had got as high as 16% people were paying for their mortgage interest rates, which is crazy. Things came down in the 90s. They started the 90s off around 10% and got down to just about 7 by the end of the decade. And then in the 2000s, you start seeing things fall to kind of the 5s and as it progressed in the 2010s, we got into the 4s. And now we know in 2020, 2021, 3 below 3 for a lot of mortgages. So even though we're higher now than where we were in 2021, we are still, from a historical context, experiencing really, really low interest rates. So for me, if my plan is to hold this property for the long term, I'm going to try and lock up this 3.85% interest rate, because 30 years from now, that's going to be like free money almost. The only reason maybe I would go with the other option is if my plan is to liquidate all three of those properties within that first 5 years, right? So if you're not planning to hold these long term, then yeah, go ahead, maximize your cash flow in the short term. Pay the lower interest rate, and then sell all the properties when you're done. But if you want to hold, I would go with the option 2 as well.
Yeah, that's a great point, Tony. And you can look at it and say, okay, well, when mortgage rates were that much higher, houses decreased because people couldn't afford them unless the sales price was cheaper. But you're purchasing this property today. So if mortgage rates do go up, you've already paid that purchase price on the property. So if you're purchasing, 3-5 years from now and interest rates do go up or skyrocket, yeah, housing prices will probably come down or level out. But that's for people that may work out for people who are purchasing properties in that 3 to 5 year, but you've already paid for this property in this really hot market right now that you want to keep a low interest rate for this property to, make sure that your numbers are going to work. And I just think the 30-year option would help me personally sleep at night if I'm going to hold on to this property. So
Totally.
Okay. Well, that is today's rookie reply. Thank you so much to Chana for sending in your question. If you guys want to have a question answered on the rookie reply, you can send us a message on Instagram at Wealth from Rentals or at Tony J. Robinson. Or you can call the rookie request line and be featured on our Wednesday episode. It is 1-888-5-ROOKIE, and you can leave us a voicemail with your question. Thank you guys, and we'll see you on Wednesday.